The 10 property terms that first home buyers always misunderstand, explained in plain English. What you don't know about LMI, pre-approvals, and comparison rates could cost you thousands. I'm Les Tricklebank, a mortgage advisor, and after helping hundreds of Queensland families buy their first homes, I'm sharing what the banks won't tell you. Buying your first home feels like learning a foreign language. Suddenly, you're bombarded with terms like LVR, comparison rates, and conveyancing. It's overwhelming, and the stakes couldn't be higher. This video will transform confusing jargon into clear, practical knowledge that puts you in control of your property purchase. I'll break down each term, explain how they're all connected, and reveal the surprising truths that most first home buyers discover too late. From understanding the fundamentals of your mortgage to building valuable equity, I'll give you the guide through every stage of the process. Because when you understand the language of property, you make better decisions, save money, and avoid those costly first-timer mistakes. The foundation, mortgage, and deposit. Let's start with the basics. A mortgage or a home loan is simply a long-term loan that uses the property as security. If you can't make repayments, the lender can take possession of your home. The key components are principal, the amount you borrow; interest, the cost of borrowing that money; term, usually 25 to 30 years. However, 40-year loans are around. Your deposit is the portion of the purchase price you pay up front. Traditionally, lenders prefer a 20% deposit, but many now accept as little as 5%. Here's where things get interesting. Your deposit directly affects several other aspects of your loan. For example, if you're buying a $500,000 property, a 20% deposit means you need $100,000 up front. A 5% deposit means you need just $25,000. But, and this is crucial, a smaller deposit triggers other costs, which leads us to our next two terms: risk assessment, LVR, and LMI. LVR stands for loan to value ratio. It's how lenders measure risk, and it's calculated as loan amount divided by property value times 100%. For example, if you borrow $400,000 for a $500,000 property, your LVR is now 80%. The magic number here is 80%. If your LVR exceeds this, lenders typically require you to pay lender's mortgage insurance, or LMI. Now, here's our first big misconception. Home buyers often think LMI protects them if they can't make repayments, but it doesn't. LMI only protects the lender. If you default, the insurer pays the lender, but they can still pursue you for the debt. LMI can be substantial. On a $475,000 loan with a 95% LVR, a 5% deposit, the LMI premium could be between $13,000 to $25,000. That's potentially another year of savings. The risk assessment equation looks like this: lower deposit, higher LVR, LMI required, higher upfront costs. Point 3, understanding loan costs, interest rates, and comparison rates. Interest rates determine the true cost of your loan over time. You'll typically choose between fixed rates, locking in for a set period, providing payment certainty. Variable rates can move up and down with the market, offering more flexibility. Split loans are a combination of the both. But here's another crucial misconception. The advertised interest rate isn't the full story. The comparison rate includes most fees and charges, giving you a much more accurate picture of the loan's true cost. For example, loan A might advertise a 4.5% interest rate, but have a comparison rate of 4.9%, while loan B shows a 4.6%, but has a comparison rate of 4.8%. Despite the higher advertised rate, loan B could be cheaper overall. According to Essex Money Smart, Queenslanders can save thousands by comparing loans based on the comparison rate rather than the headline rate. Always ask for this figure when shopping around for loans. The process: pre-approval and conveyancing. Before seriously house hunting, you want pre-approval, sometimes called approval in principle. This is a lender's initial assessment of how much you might be able to borrow. But here's a crucial point. Pre-approval is not a guarantee. It's conditional on the lender's valuation of your chosen property, verification of your financial information, no adverse changes to your circumstances. I've seen buyers heartbroken after having offers accepted only to have pre-approval withdrawn because the bank valued the property lower than the purchase price. Once you've found your property and had an offer accepted, you'll need conveyancing, the legal process of transferring ownership. A conveyancer or solicitor will review the contract of sale, conduct crucial searches for issues like easements or planning restrictions, prepare documents for transferring the title, and coordinate settlement. According to conveyancing professionals, DIY conveyancing can save you a few $1,000s, but risk mistakes that could cost you tens of thousands. Final stages: stamp duty and settlement. Stamp duty, or transfer duty, is a state government tax on property purchases. It varies significantly between states and territories, but can add tens of thousands to your costs. For example, on a $600,000 property in Queensland, standard stamp duty is about $13,000. First home buyers may receive concessions, potentially saving thousands. Settlement is the final stage where ownership officially transfers to you. On settlement day, your lender provides the loan funds, you pay the balance of the purchase price, legal ownership transfers to you, and you finally get the keys. After working with hundreds of first home buyers, I've noticed recurring patterns about these terms. First, understanding the connection between deposit size, LVR, and lender's mortgage insurance is absolutely crucial. Many buyers focus solely on saving the minimum deposit without realizing how it affects other costs. According to CoreLogic data, first-time buyers who can reach a 20% deposit not only avoid LMI, but often secure better interest rates too. Second, don't be fooled by the headline interest rate. The comparison rate reveals the true cost. A recent Mortgage and Finance Association of Australia study, MFAA, found that loans with the lower advertised interest rates weren't always the cheapest once all fees were considered. Third, bank valuations can differ from the price you agree to pay. If a bank values a property at $480,000, when you've agreed to pay $500,000, your LVR increases, potentially triggering lender's mortgage insurance or requiring you to contribute more cash. Fourth, when weighed against long-term property appreciation, paying LMI to enter the market sooner sometimes makes financial sense. For example, in Brisbane, property values increased by approximately 27% in 2021 to 2022. For someone buying a $500,000 property, waiting an extra year to save a 20% deposit instead of entering the market with a 5% could have meant missing out on over $100,000 in capital growth, far more than the cost of LMI. Finally, your equity. The difference between your property value and what you owe builds through both loan repayments and property appreciation. This becomes a powerful financial asset over time, potentially funding renovations, investments, or your next property purchase. Now that you understand these essential terms, you're already ahead of most first home buyers. But knowledge is just the first step. Here's what to do next. First, get clarity on your deposit situation and what it means for your LVR and the potential LMI costs. We offer a first home buyer strategy session where we calculate these figures precisely for your situation. Second, if you're ready to explore your borrowing capacity, we can help you secure a comprehensive pre-approval that gives you the confidence when property hunting. Third, we have a network of trusted conveyancers who specialize in protecting first home buyers throughout the purchase process. We've helped hundreds of first home buyers in southeast Queensland navigate this process successfully, and we'd love to help you too. Understanding these 10 terms puts you miles ahead on your home buying journey. In future videos, we'll explore other crucial aspects of property finance, including first home buyer grants and schemes, how to improve your borrowing power, and strategies to pay off your mortgage faster. Hit subscribe to stay updated and leave a comment with any questions. I personally respond to every one. Remember, property jargon is designed to confuse. With the right knowledge and support, you can approach your first home purchase with confidence. I'm Les Tricklebank, a mortgage advisor. Thanks for watching, and I'll see you in the next video.